This is the Texas Land Guys podcast, hosted by brothers Tim Dosh and Tom Dosh. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Welcome to the Texas Land Guys podcast. We have a good episode today where we're sitting down. I'm here in Dallas with Trey again. Tim, you're sitting in Houston with David Marshall. This is going to be a kind of a fun wrap up to the year. I can't believe that it's almost Christmas and we've already gotten to this point in 2025.
Yeah, it just seems like it wasn't long ago we were sitting down talking about what 2025 would be and what trends to expect and what the themes would be and everything. And we're already here at the end of the year. So it's crazy.
I remember being retraded on a deal in 2023 and the client mentioning survive to 2025 at the time. And so, Trey, I'd love for you to say what you've been telling people.
Yeah, I've been joking that I survived 25.
Yeah.
Yeah, it's been a I'd say a challenging year. I mean, there's been a lot of good, and we'll get into that, and we'll talk about a lot of deals that we worked on and closed, and just a good overall year. We had that episode recently on grit and tenacity. Really feel like that could be a theme for especially our Austin office, just how they have done really well and performed in a difficult environment in Austin with just a lot of supply. But I think for us, it's been a year of challenges too. It's hard to get deals capitalized in our markets. There's been a lot of things we didn't see coming. Maybe we start there and talk about some of those.
Yeah, I think the biggest thing was tariffs, which we did talk about, I think, in that one of those first episodes. And we didn't think, I didn't think it was going to be as big a deal as it was. And it was definitely a huge story, as we got into the springtime in April and May, that really impacted the market, really impacted single family a lot. And so that'd be a good one to probably start with, because I don't think we were expecting Trump to really ratchet things up the way he did.
Yeah, I agree. I mean, for you guys in Houston, when did you start to see some impact on that? And then how has that or is that impacting some of the deals you guys have worked on?
Yeah, that's a good question. Definitely didn't see it coming. I just to back it up just a little bit. I kind of took this year when people ask me how'd the year go, and I kind of just describe it as I just kind of bumped along, and that's what it felt like all year. And talking about things that happened, but also things that didn't happen that we were expecting to happen as well. But on the tariff front, it's hard to gauge because I think you saw it more through the consumer. Not to say that we didn't see it from our developer clients as well, because they're obviously getting hit with it too. But it was one of those things at the end of last year, we were hearing about cost coming down, but I didn't necessarily hear a ton about cost going up because of tariffs. Now, it's definitely happened, but I don't have an exact percentage or anything that we heard of it going up in 2025.
Yeah, I think you're making a really good point, David. I think that the real story is not tariffs in 2025. I think the story is the consumer is weak, especially the bottom half of the market, because of rates being high. People are putting things on credit cards. There's a lot of consumer debt. There's fear on the consumer side. And so I think the tariffs were really more psychological. The market reacted very strongly. I think that people got scared on just the consumer side, but also the institutional side. There was a fear of what's going to happen, how big of a deal is this going to be. I think that the real impact probably was not as significant when you look at things really costing more from a development standpoint, because we have seen costs come down for the most part. But
I think the biggest effect it had was, like Tim just said, maybe the cost didn't go up much. They maybe came down, but where we saw it affect, especially in the multifamily world, was rental rates have gone down. Yeah. And I think what's happening is, like we alluded to earlier, the consumers are getting hit harder with higher prices at the grocery stores, higher prices basically everywhere. Mm-hmm. And because of that, they have less money now to spend on rent. And we've seen rents come down a good amount here in the Houston market. Not every sub-market, but specific sub-markets. A good example is, the Washington corridor, where rents were in that kind of $240 to $250 range, or $235 to $245 range. We checked them the other day, and now they're in the $1.90 to $210 range. So when you see that much movement in rental rates, a lot of things don't underwrite. So I think that's where the big effect was, at least in the multifamily world.
Well, I think what you guys are talking about with uncertainty is always really difficult. And so up here in Dallas, Trey, I'm interested to hear your thoughts on tariffs because we've talked about it all year.
Yeah.
Seems like a lot of it was just the uncertainty of like, what's Trump going to do next? We're like making a deal. We're not making a deal. Now we're going back, and our clients just didn't know what to do.
Yeah. Well, it's interesting because before tariffs, you think about the inauguration and the first 60 days of the year before we even got to Trump's imposed tariffs. I don't know if you remember the first 2 months of the year, we signed up like over 20 multi deals in Dallas. So it was very, very fast and furious to start the year. And then the tariffs hit and it was just like a sledgehammer on everything that we were trying to do. And so from that standpoint, the next few months were very, very uncertain. The stock market had a huge dip, all that, just cloud of uncertainty. With that, plus everything geopolitically that was going on in the world, relative to conflicts and things of that nature. There was a period of time in the spring where it just felt like we had gone backwards in the market.
Mm-hmm.
And that was very difficult. There were a lot of deals that fell out just due to uncertainty. And I think, once there started to be more clarity around, okay, who's actually going to get stuck with tariffs and what's the percentage going to be, and you start to have some real numbers thrown out, that's when I think we kind of got into the summer and I felt like there started to be a big pickup and steam rolling again.
Yeah, I was like, as soon as we started to feel better about tariffs, then we had the government shutdown, like towards the end of the year.
Yeah.
And then I remember being on a call with Trey on a big listing we have, and the owner was like, we don't want to make any decision because of the government shutdown. And so even though the government shutdown itself doesn't really have a very direct impact on our business, I think, Tim, what you just said about psychological, I think that's really what the impact is. I mean, the uncertainty that it creates, whether it's tariffs or the government shutdown. Tim, you mentioned earlier with the attack on Iran's nuclear facility. I think we expected a lot bigger reaction from that. And we really didn't see that. There's a lot of interesting things that happened this year, but I think that ultimately the whole survive to 2025 ended up being more of, like you said, David, bump along in 2025. Deals got done, but it was hard. Like it was much more difficult. Maybe it's interesting to talk for a minute about where that leaves landowners and developers. Like David, you sent an article out yesterday to the office where the article was about landowners and probably more investors that bought land in 21 and 22 in Texas, across the Texas Triangle, at elevated pricing where they are today. 3 years later, in some cases 4 years later, a lot of that debt's coming due. I don't know. What does that look like in Houston? I mean, we're definitely seeing some of that in Dallas, and people are just hanging on by their fingernails to these deals, getting extensions, and just trying to keep deals alive.
Yeah. So, on the land front, we haven't run across a ton of landowners who have, a lot of leverage on their dirt. I'm sure it's out there. And, if you do, it's problematic. As we saw in the Great Recession, a lot of land was given back because land got levered. People took out loans and put it on a non-cash flowing asset. I think the market learned a lot and lenders learned a lot from the Great Recession, as we all did. And we haven't seen nearly as much of that as we have in the past, or as we did during the Great Recession. So it's out there, no doubt about that. But we haven't run across a ton of it here in Houston.
Yeah, and I would say, even to go to just kind of like a 50,000-foot view of the market, I think we've seen so much in our career, these, especially in Houston, these big dips, whether it's a Great Recession or when oil crashed or COVID, where the market corrects really hard, and it's really hard to do land deals for, a year or maybe, 2 years in some cases. But then the market comes roaring back and it gets frothy and there's these crazy new prices being set and everybody's buying deals. And my view has kind of shifted over the last couple of years, where I don't necessarily expect us to come back to some roaring, frothy market over the next couple of years. Now, we might, and I hope we do as a broker, but it just seems like there's weakness in the market. It doesn't seem like we're going to see super low rates again. Maybe we see somewhat lower rates. But I think that there's a softness in the economy with the consumer. I think that people are struggling. I think there's an aspect where there's a lot of money at the higher end of the market. People are making money in the stock market. There's maybe made off AI. Um, People with a lot of expendable income, but there's not enough of those people. And so I think as that trickles down to, seeing weakness in single family home sales, seeing rents falling, I just feel like the market is not super strong. And I think we will see more resilience in Texas because I think we're going to keep seeing, people moving here. We'll see jobs created in Texas. I think we'll see opportunity in Texas. So I'm not trying to be negative. I see the rest of this decade being very similar to the 90s, where in the 90s you had, very rough 80s, and then you had a recovery in the 90s where things were just, they were good. They weren't great and they weren't bad. People did deals, but deals had to make sense. They had to underwrite. People weren't just overpaying for stuff left and right. There wasn't a ton of money in the market. And so that's kind of where I'm thinking things are today. I could be 100% wrong, and I kind of hope I am because it's not as fun of a market. But I also do think it creates opportunity for the strong developers and strong brokers. There's still deals to be made, and we'll talk about this year was still a good year for DMRE. A lot of deals got made this year. A lot of deals got closed. I think we'll keep seeing that. But I just don't know if it's going to come back to where we see a lot of deals that don't make sense getting done like we have in past cycles.
And one thing to add to that, and it's kind of it's add on to Tim's point there is, all the use type. It's not like all the use types have shut down and not been active. It's been one use type will kind of rise to the top and be active, and then there will be a shift in the market next year, and that use type will slow down, and another use type will come up. So, for example, single family development in 23 and 24 was very active, and those developers and home builders were very active in the market, where industrial and multi slowed down. But what's happened in 2025 is single family has started to slow down and industrial has risen, and now those developers are very active. So they all haven't slowed down at the same time and not been active. It's been one's been active while the others weren't, and then that shifts and changes from year to year, which it's been, like Tim said, it hasn't been a great market, but it's been a good market, which has allowed us to get deals done.
Mm-hmm. Well, we'll get into the use types here in a minute, but I think it'd be interesting to just compare our markets. And so I'll let Trey kind of speak to what we've seen on debt on land, but I think maybe just very different than you guys. And a big part of that might just be the difference between DFW and Houston. Houston's had a lot of rockiness over the last 15 years, the ups and downs, Tim, that you're talking about. And Dallas has had some ups and downs, but they've just been a lot more ups and then a lot, I don't know how to say it. The downs haven't been as bad as they were in Houston. And so you have a lot of investors that have made a ton of money. I mean, just an incredible amount of money. A lot of them have been doing it with debt. There's just areas of town where most of the land is owned by investors, and they have been trading in and out of land. I mean, the way it works in Dallas is if you own land kind of north of town, you just buy a site and then you sell it, and then you go a little bit further north, and you just keep doing that every couple of years. And that's what a lot of people have been doing. But Trey, we've been seeing now those deals were put together in 21 and 22. Some of those guys flipped out of them really quick, bought new sites, but we are seeing some leverage, and we've seen all kinds of different percentages of leverage. What are your kind of thoughts there on maybe what we'll see going into 26 and what we're already starting to see with it's hard for people to maybe sell where they thought they were going to be able to sell?
Yeah, and I think to circle back to the point we were talking about just a minute ago, relative to just the overall market, I think the thing that's been really interesting about 2025 is that construction debt has really come back. That is the piece of the puzzle that's been relatively available. It's been finding an equity partner that's been more of the challenge. So that's really helped to get things across the finish line if you can find an equity partner, obviously. But relative to where we're at in the market and just where investors are at, there's a lot of sites like you're mentioning where an investor maybe bought it in 2025 and, they had a long time horizon on that deal. And it's almost like they're stuck because the price is not what they paid for it. And, there's a little bit of stubbornness there where, hey, they're not prepared to take a loss. And so there's a lot of sites that are investor owned where people are having some pressure from investors, pressure from land loans, et cetera, to actually move it. And so we are occasionally seeing some of those price drops to a point where it makes sense today, but there's a lot of those sites where the landowner just does not want to move off their price, and we almost just check out on the site. Like there's not really anything to work on here because there's no way we're going to get to this price.
Yeah, and I think we've seen that, like to your point, Trey, with developers and investors, because there's a lot of developers that bought at the height of the market, but then so many other developers bought in the same submarket.
Yep.
And so you look at certain areas right now in DFW, whether it's single family, multifamily, or maybe build to rent. So kind of the whole residential space. There's just a lot of areas that are almost like no fly zones.
Yeah.
So we're, to your point, kind of checking out on those areas.
Yeah, and I mean, we always say we're blessed to be here in DFW, right? We're very fortunate that it's a diverse economy and there's still a lot of activity, and there's definitely some markets that are oversupplied from a development standpoint, but there's enough mileage in DFW where you can just go find another spot that maybe doesn't have supply and still get something done. The other trend with that we really saw this year was we finally started seeing developers let go of sites that they didn't have a clear path to breaking ground on. So we had a lot of deals that were selling on behalf of developers where they finally threw their hands up and said, look, we're either we've burned through our opportunity to make a promote here, or we just realize we're at too high of a basis, whatever it may be. There's actual developers coming to market and moving on from projects.
Yeah, in some cases, it's been some difficult conversations with developers where they bought in 21 or 22 and the sites are worth a lot less. And I think everyone thought that by 2025, we would have worked through the market. It's really easy to think like, well, in 2 years, all of our problems will be solved and like the market will be better. And it's just not. And so Trey and I were talking to a developer that bought a site really urban in Dallas back in like 21, 22. Site's probably worth, 50% of what they paid. And there's really no path to getting back to what they paid anytime soon. Like there's no reason I could logically present to you guys on like why that area is going to come back. That area has had a lot of issues. And you've seen this in Houston where there's like an area that's in favor and then it just moves to a different area. And all the excitement and energy and everything that went into that area, it just kind of moves. And unfortunately, that's where this developer is. They, I think, are acknowledging that and they're probably going to sell in 26 and just move on. But then there's another developer in a very similar situation. They also overpaid around the same time frame, urban, really expensive deal. And their stance is they keep turning down offers that like almost get them out at their basis. But their stance is we think it's just going to come roaring back in the next 12 months. And again, I don't specifically for that submarket inside, I just don't see it. And then Tim, with what you're talking about with just softness in the market, I just don't see it. But I think that you have a lot of people holding on. Both those developers are not local. One of them was like, I've never been to the site, but tell me about it, And so it's like, it's hard because all we do all day long is talk to developers, and so we have our opinions. And like you said, we hope we're wrong. We hope these areas like come back, but we're very in tune with the development community. And there's some of these areas that are just gonna be really difficult. So there could be some tough decisions for developers to make, because developers, I think, are a lot more likely to need to sell than some of these investors. Because even if you don't have debt, you don't want to sit there. You've burned through your promote. It's just time to move on. And that's going to be probably the case for some of these sites in DFW.
Yeah, where we're seeing that problem, it's usually we can bridge the gap on suburban sites between whatever development type it is and the landowner, where we're having the biggest struggle. And there's not a ton of activity, and there's couple reasons why. The first reasons why is it's been very difficult to bridge the gap between where developers can pay and what infill landowners want. And I liked how you coined that, Tom. That's definitely been a no-fly zone here in Houston. Is infill land is just tough right now. It's hard to get anything to underwrite, and there's a gap between what landowners want and what developers can justify to pay.
Yeah, and the landowners don't understand that it's a no-fly zone. So, so sometimes you'll submit a really good offer, and we understand that like this is a really good offer. Not to say we could never bring a better one, but it's hard for those landowners. It's not what they expected, and they don't have that full breadth of knowledge. And so especially if we're not representing them and we're just offering on a site, they may pass up on what could have been, really good sale, and to just move on from a property.
Well, it's a good, I think, point also to make that there's a lot of people who they're real sellers at a certain price, but they're not real sellers unless you get to that price. And so the Houston Infill market is a good example. If someone has a good site, they may recognize the market's not very strong right now. I can't get to my number, but I'm okay waiting 3 or 4 years and hoping it comes back and getting back to that number. And it may or may not. I mean, some of the numbers that people have in their mind in Houston are, $200, $300 a foot for some of these infill sites that, it could come to that number, but I don't know if it will unless things really change in the market. But I think that's an interesting thing to think about as we look at this year and moving in next year. What makes someone a real seller, and what makes someone just say, hey, I'm going to sit on the sidelines and wait because I just can't get to my number.
Mm-hmm.
Another good thing to talk about, we talked about things that did happen this year. I think it'd be good to talk about things that didn't happen, or at least didn't happen at the rate we thought they would. And I think y'all probably know where I'm going with this one is, decline in interest rates.
Yeah.
Mm-hmm.
We were seeing this time last year in 2024, and I think that was kind of on the horizon. Everybody thought that was going to happen a lot sooner than it did, and, a lot more lower,
significant.
more significant drop. And it didn't happen in the first half of the year, and it's been a very minor rate reduction. We've had 2 rate reductions, 50 basis points over, the last couple months. And so that was obviously something, like I was mentioning, we were expecting to happen. And I think pretty much the development community and real estate community as a whole thought that was going to happen.
Mm-hmm.
Yeah, that's a great point, David. And I think probably rents, for sure, on the multifamily side. I don't know. I think we all knew this was a year where there was going to be a lot of supply, and everyone was talking about the cliff of supply and how we were going to kind of get to the top of the mountain and then it just drop off. But I didn't personally expect rents to come down to the level they have in some of these areas, and probably I would say pretty much across the board. I'm sure there's some cases where they haven't, but I mean pretty much across the board here. You go look year over year, rents are low, and in some cases, some of the lowest rents I've seen on new product like 10 years, just on what people are actually getting. And I think it's a function of maybe some of that supply, maybe a little more supply than was expected. Maybe deals took a little bit longer to get done. They all hit around the same time. And then what you said, Tim, and David, just about the softening in the market from the renter perspective. You can't pay like double for groceries and keep, increasing your rent. Mm-hmm. And we just delivered a lot of homes and a lot of multifamily.
What about SB 840? Because I think that didn't have an impact in Houston, but obviously that was a big news up there in Dallas and, probably in Central Texas as well. I know you guys had a lot of activity, with SB 840. How do you guys see that right now about how many deals are actually closing with that and what's the impact of that?
Yeah, I don't know that we've actually seen any deals close from SB 840. We're definitely starting to figure out which municipalities will actually cooperate with it, and it's very few, unfortunately. There's been a lot of trial and error, but it's going to take a couple of years, I think, to really flush out and get that bill to where everyone wants it to be and where the state wanted it to be when they passed it with such a majority. You've got some cities who are basically just sitting back saying, sue us, we don't care. Like there's a city here in DFW that developers have gone and met with. SB 840 clearly qualifies in their city, and they've just basically taken the position of that doesn't exist. We don't know what you're talking about. And so I think there's still a lot of wood to chop on that, but there's definitely a couple municipalities that have shown their cards of, hey, if you cooperate with these, certain requirements, like we will adhere to the law. Which is awesome, and we've actually got a best and final today in one of those municipalities where it's been inundated with offers, and they've been way more aggressive than we ever could have expected. So I think from that standpoint, there's still a lot of good going on in the market, but it's definitely hasn't been quite what we thought it was going to be when we first started working on it this summer.
Yeah, probably the biggest change there from when we sat down with Tommy Mann and talked about the bill, and Tommy went through like all the cities in DFW, was that at the time we really thought that Grand Prairie was going to play ball and just kind of like some of these other cities like Dallas. was going to come out and just kind of say, okay, this is how we see the bill, but we're gonna work with the state on it. And so Tommy talked about that in the podcast, and that ended up not being the case at all, kind of to everyone's surprise. I mean, we were all really surprised. It ended up they were just keeping really quiet on the bill and how they were going to respond. And then they came out with some what we felt like were a little bit like off the wall requirements, like 60% 3-bedroom multifamily units, Olympic sized swimming pool, 4% on permanent art that has to be a part of the deal. It's like I just would have loved to have been in the meetings brainstorming those type of requirements in the ordinance. So that's interesting to me because I think some of these cities maybe just went too far, to Trey's point, and there are going to be lawsuits, and it is a state law, and there's a lot of people impacted. There's a lot of landowners impacted by this. There's a lot of developers impacted by this. And so some of these cities are really flexing their muscles, and it's going to be interesting to see what the state does. And then also if there's some class action lawsuits. We've had some attorneys reach out to us, like out of state, guys from like New York and stuff, reaching out asking if we can direct them to people impacted. They want to go after the cities because obviously there could be some big fees involved if they could win. So it's kind of a popcorn moment to sit back and see what happens. Yeah. But it's not a flood of deals coming to the market. It'll probably be, like Trey said, working through this for a couple of years. And then we're just trying to be really strategic where we spend time on it. But I would say 70% of the cities are being difficult. Yeah. It's a heavy percentage.
And I would just say that one thing that I think that has come off of that is we have gotten control of some good sites where it's like, hey, the city doesn't want SB 840 anymore, but hey, that's still a really good site. We got control of it. Can we go get it rezoned? So it's still leading to activity. It just, to your question earlier, it just has not led to any closings or anything of that nature.
Yeah, just too early.
Yeah.
Yeah, we know the way developers are. Even if you should be able to develop there and you can go sue them and win, no one's going to go spend 3 years on a lawsuit to beat the city and build. I mean, that's just not. I mean, maybe one guy does it, but it's just not worth it. They're going to go, find a site that's in the ETJ or a site that you can develop by right, or that has a good chance of getting rezoned and go do that deal.
Yeah.
So.
Well, maybe it's a good transition into some of the positive things that happened this year, and so we can talk a little bit about just activity we've seen, and then some of the deals that we have closed that were exciting deals. A couple quick thoughts on that. Trey and I were at lunch last week with the developer, and they asked us, and it wasn't a joke. They were just like, "Have you guys closed anything this year?" Because I think it has been a hard year for a lot of people, and in a lot of ways, when whatever asset type you're in, you look at deals and it's hard to underwrite. It's hard to find capital. Trey's point about equity is so true. And even in industrial, which has been the strongest asset type in DFW, it's still difficult to make deals work or find the right deals. But fortunately, we have closed a lot of deals, and we were talking about it before the podcast started. A lot of the deals we closed started, in 24 or 23 and started, a couple of years ago. And that's just part of our business is whether it's zoning or capital or, seller issues, like some of these deals just take a long time. And so there's quite a few that have just, taken quite a bit. But Tim, do you want to run through the kind of what we've closed across Texas?
Yeah, so we've closed around 100 deals, a little bit over 100 deals across all the DMRA offices. About half of those are in Dallas, which has just been a very resilient market. And then Houston is about 30%. And then the Central Texas market about 20%. I think that's the market that's been hit the hardest. We actually have seen some great deals still close in Central Texas, but it's just been a really hard market. They're getting hit on the industrial side, multifamily and single family, just kind of across the board. I think in the Houston market, industrial has actually been really strong this year. We've seen industrial activity pick up a lot. Pricing has picked up a lot. We have a lot of deals that will hopefully close next year that we're putting under contract this year for industrial. We actually had some big single family closings this year, but single family slowed a lot the second half of the year. And then multifamily has been steady, but nothing near what it has been in the past. I mean, we're getting deals done, but it's really a handful of the strongest developers who are active, who are putting sites in our contract. I don't know if you've done anything to that, David, but
yeah, I think like you said, where we saw the biggest shift was single family slowed down a lot. I mean, it didn't slow down to where they're not still active and looking, because I think those guys are always looking ahead, and they recognize that, Texas is still experiencing good population growth. So they got to stay ahead of that because they never want to be in a situation where they don't have lots to sell or lots to develop homes on. It's a bad position for a home builder to be in. So they're always looking ahead, and they look a lot further out than a lot of other type of real estate developers. But that's been the biggest shift. And then, like you hit, industrial has really been picked up. Industrial has been very, very active. Those developers have been very, very bullish here in Houston, and that's probably, I would say, been the most interesting shift and change in the market that we've seen here in Houston.
But over 100 deals closed is a really good mark, I think, for this, good achievement for our company with this market. And I would say, I think next year we have the biggest pipeline in our company's history for deals that are under contract to close next year. Now, nothing's closed till it's closed, and we've seen deals, get extended for years and all kinds of crazy stuff. But there's still a lot of opportunity, and there's a lot of real deals with hard money and serious developers, good sites, deals that make sense. So we're optimistic about 2026. I feel like our team is really strong across the state. I think each office has really strong brokers. There's been a need to be, very resilient and work hard and have deals fall out over and over again and just keep, coming back every day and working hard and putting new deals under contract. So it's been I would say, a very character building time, probably for each of our offices going through the last couple of years.
Yeah, and there's some big milestones. I think we hit 800 closings all time this year, which is exciting. We crossed the billion mark here in DFW and 150 closings up here, and so that's been exciting just to see the year-over-year growth that we've had. And so many of the deals are deals that we've been working on. Some of them start to finish this year, but a lot of them, we've been just persevering the last couple of years, and so we're on a good growth trajectory here in DFW of just each year's been better than the year before. And this year was a great kind of growth percentage above what we did last year, which is exciting. Trey and I are always looking at that just to see like what kind of traction are we having. The market has been choppy that whole time. And even as a company, 2025 will be, I think, our second best year ever, only behind 2022, which was like a half a year. It was like the first 6 months of the year were incredible, and then the market really turned. But I think we even though we talked about we survived 2025 and all that, I think that really proud of just all of the work from all of the teams, the weekly calls that we do as a company and updating on stats and where we're at and what we're working on, and knowing that like Trey said, here in DFW, there's a lot more positive things going on and just reasons that developers and capital want to be here than maybe Central Texas. But the Central Texas guys still had a great year. I mean, having over 20 closings in Central Texas, institutional, big deals. You would think, talking to the development community, that like nothing's happening in Central Texas. And I think for a lot of groups, there isn't really anything happening. And so those guys getting up every day and getting after it and getting those closings was a big accomplishment. So super proud of the job they did.
Yeah, and that's a good point, Tom. We're not talking about, small deals. I mean, one of the Central Texas deals was over a $40 million land sale. So, I mean, there's still some really big deals happening that our offices are getting to transact, which I think is pretty special when it's just that difficult to get those kind of deals done. You see those deals happen in a frothy market, not as much in this market. There's a couple that get done, and we've been blessed as a company to get to work on those deals.
Trey, they kind of went through the use types in Houston. Do you want to do the same for DFW, just kind of running through what we saw in 2025?
Sure. I mean, I think similar to what you guys said, industrial is definitely the hottest product type, specifically on the second half of 2025. I expect that to continue at least in the first half of 2025. When you think about that, a lot of the deals that are getting done are in more proven markets, more infill type industrial markets. Could be redevelopment. It could just be overlooked sites. I mean, we've closed some pretty incredible deals that are not too far from DFW Airport that have been smaller sites with 6, 8, 10 acres that are institutional developers with institutional level capital. And that's just where everyone's kind of competing right now. But you're definitely starting to see here in DFW the kind of demand for more larger larger acreage industrial sites going back out further a little bit, just because the supply of those has really fallen off. There's not as many out for lease right now. So I definitely expect industrial is going to continue to stay strong. We're really excited about that asset class. Multifamily has continued to be, a staple of our business, obviously. It's definitely hasn't quite been the year that, again, we thought it was going to be when we started 2025, but it's still been a really good multifamily year. And I expect that 2026 is going to be a really strong year for multifamily here in DFW. Every developer you talk to is projecting that when we get to 27, there's going to be rent growth again, and everyone's trying to time up to deliver at that point in 27 and 28. So we have a lot of activity. We have a lot of deals under contract that are, scheduled to close next year. I'm sure a lot of those will probably, hopefully, knock on wood, get across the finish line. But what's interesting too about multifamily is when you look at our closings this year, I think it's around 15 multifamily transactions for the year. It's split pretty evenly. We get this question a lot of like, how many of those deals were into construction? And it's actually surprising. It's less than you would think. Probably a little less than 50% of those deals that we closed were actually with a partner and into construction. A lot of them were just, hey, it's a good story. Maybe it's what we were talking about earlier with a developer moving on from the product, or moving on from the site rather. Just a developer going and taking down land. So we're still seeing a lot of land takedowns in multifamily, which is it's great. So I expect industrial and multi to continue to be strong moving into 26, and then single family, obviously more as a broader Texas discussion. It's definitely slowed down, particularly after the first and second quarter of this year. Builders are really resistant to have land on their books, and everyone's having trouble with sales. So same thing relative to all asset classes. We've seen single family trying to pull back in to more proven markets. It's interesting when you look at those closings. It's a lot of finished lot deals, and it's a lot of developers taking down land to build lots. There's very few transactions right now that we're seeing that are just paper lot deals. So it'll be interesting. Tom, I don't know what your thoughts are relative to how we move into 26, but I definitely think that single family will still have its place. I think it's going to be a lot more, like I said, finished lot deals and development deals.
Yeah, I think you brought up a really good point about multifamily, that it's been incredibly active from a demand standpoint.
Yeah.
Like every developer we meet with is like, I've got to get a start in Dallas. Like Dallas is our number one market, and we've got guys flying in from everywhere. All the local guys are looking for deals. I mean, it really has been all year long. It's like, this is the top market. And then it's like almost no site underwrites. There's so many sites we sent to groups, and they don't offer on anything. It doesn't underwrite. And then there'll be like the site that does, and then everyone offers on it. And so Trey mentioned a minute ago, the SB 840 site. And that's when we're like in a week period, maybe a 2-week period, we've gotten, 15 offers just from a targeted group of multifamily developers, because it really makes sense. But then there's a lot of these other sites that just don't make sense and won't make sense for quite a while. And so I think it'll be interesting in 2026 to see, just with that much demand to get deals going, what's going to kind of break, because rents have not gone up, but construction pricing has come down. It's kind of the one positive. But then with rents not going up, it makes it hard for a lot of these deals to work. But maybe we'll see these developers and partners being willing to take a little bit lower return just to get deals going and on the books. That'll be interesting to see, because for the demand we've seen this year, to Trey's point, we have not seen a correlation of closings. It's just hard to find deals that make sense. And when it comes to single family, I think you nailed it, Trey. I think the activity is going to be more back to the core areas, maybe a little bit more creative infill, more like townhome development, that type of thing. And then there's a lot of builders that probably just need to exit some lot positions. And so I think you'll see a lot of trading and a lot of just getting out of positions in some of the more like tertiary areas that got really hot, really aggressive. And then still there's going to be these big master plan plays because they're so down the road. They take so long and, they're 2,000 acres. And so we'll still be working on a lot of those because those kind of click along. If they can get this time from the seller to solve the issues, those just continue to move forward, even in this type of market.
Yeah. I know, Tim, we were catching up earlier about just infill push relative to multifamily also. I would say right now in DFW, we're probably working on more wrap sites than we ever have, just because that's where things are underwriting and that's where the demand has gone back to. And so there's less of this just suburban sprawl, go build it for as low a basis as you can, and more about proven quality and being back in some of the semi-infill markets.
Yeah, that's a great point. I think it's a really good trend to talk about. We thought infill would start to come back this year, and I think it was a little bit more delayed than I thought it would be. We actually closed 6 infill deals here in Houston, which was big for us because I don't know if we closed any infill deals in 23 and 24. It was that dead, but we saw sellers start to exit infill sites and just take what they could get. And so those deals were better values than maybe we would have seen in the past. But in the last probably 3 or 4 months, we've seen a big shift from some of the stronger developers saying, hey, we'll do multiple infill deals. We want wrap, but we'll look at podium. And we want to be in the good markets, and we're willing to pay some prices that are pretty strong pricing. I mean, north of 100 a foot, maybe mid hundreds a foot, for some of these better sites. And I think the story in Houston is there's been almost no supply at all in the infill market, and there's not going to be supply. I mean, we've never seen in our career, going back over 20 years, this long of a drought on infill supply, which unfortunately the rents are actually still soft, which shows you just how weak the market is here in Houston, that you'd have no supply, but still soft rents in the infill market. But I do think there's some good barriers to entry and the groups who can come in right now and tie up some good wrap sites, get them capitalized and get them built. It's going to be hard to have a lot of supply compete with that over the next couple of years.
Yeah, because you're talking about a wrap product, a 2-year time frame to build that. So, and it's hard for a lot of these developers and these equity groups and lenders to bite off on the fact that, hey, the rents are here now, but in 2 years out, we're projecting the rents to kind of move back up. And to the point we made earlier with tariffs and inflation and things like that, you've seen a rise in goods, and I think that ultimately has affected rents. That's hopefully is getting worked out of the system, and then but you got to look forward, and the timeline for when they will actually be delivering units on a wrap deal at the earliest is 18 months. So we're talking where we sit now, you're talking mid 2027 at the earliest.
Yeah.
And more than likely probably at the tail end of 2027.
You guys want to talk about a couple of the deals specifically that you guys worked on and closed this last year or this year?
Yeah, I think two that would come to mind that'd be good to talk about. One of them was an infill site that we'd actually sold back in 21 to one of our developer clients, and it was in a real good submarket in the Heights. They got it at a good basis, and just through a lot of things, decided not to build it, and they decided actually to sell a couple sites at once. One of them was up in the DFW area as well that you guys worked on, but they came to us in the spring and said we need a quick closing, and we're thinking, man, it's an infill site. Quick closing, it's going to be really tough. But we actually had a number of really good offers, groups you could close quick, and we sold it for a higher, per square foot price than what they paid for it back in 21, which we felt really good about. And I think the developer who bought it still got a good deal because we believe in that submarket. I think it's a good site. It's a good submarket. Like you said earlier, Trey, they didn't close in a construction loan. They just took the land down. So, when they get a construction loan and actually capitalize the deal, it'll be interesting to see when they actually can build the deal. It may be longer than we think before they get that done. But that one was, I was surprised at how strong the market received that deal.
Mm-hmm. I mean, we still had 8 offers on that, give or take. So
and there were a lot of groups that were in this similar price range. I mean, the offers came in probably 20% higher than I thought they would. And then
hard money day one,
on
a couple of them. So
Yeah, they're very good. And then the other one that comes to mind was a big deal to do with Hines down in Lake City, almost a 1,500 acre takedown on a huge master plan community right there, straddling the Grand Parkway, future Grand Parkway, either side of the Grand Parkway. So that was a neat one to get done. We actually had, I would say, maybe about almost 5,000 acres of single family deals closed this year in Houston, which is definitely a record for our office. Just a lot of big deals that we've been working on for a couple of years. It just all happened to get done. This year. But those are some big ones.
Yeah, and the big one down in the 1,500 acres that you mentioned, that isn't a deal we put under contract this year and closed this year. It got put under contract, I believe, in 21 or 22.
Yeah, I think 22 maybe. Yeah.
22. So it was a long drawn out deal, but at the end of the day, it was a good result.
Yeah.
Yeah, kind of piggybacking on the first one you talked about, Tim, because we did work on the other site for the client up here in DFW. That was probably one of the harder assignments we've ever gotten, because when they called, it was late spring and it needed to be closed by the end of August. And so that was, then they wanted us to do a BOV. And so trying to put a value, I don't think people realize how hard it is to do a BOV on a property in the kind of market that we're in. We already talked about tariffs and everything we were going through. And then to say, like, you haven't even gotten to go to market yet, but it needs to be off the books, closed. And so we're thinking, marketing, offers, negotiation, selecting a group, PSA negotiation, due diligence period. And basically we're going to get one shot at the whole thing, and it's going to be on a very condensed timeline. And then now you also want us to tell you, like, what we can sell it for. And it's just a piece of land. The one in Dallas was a little bit more complicated. And, the one in Houston was a wrap singular project. The one in Dallas was mixed use, lots of topography. Ended up there was a deed restriction that wasn't really known about. Just a lot of complexity to it. And so we did the BOV, we took it to market, we ran a very quick marketing process. We kind of did it simultaneously with you guys, obviously from a timing standpoint, just to make it easier for the seller, since it was the same seller. But also up here, how many offers did we get, Trey?
I think we got a dozen offers on that one.
Yeah.
I think the incredible thing beyond the offers that we got was just that we had 3 groups with hard money day one. And I think the group that moved to contract and ultimately closed it was $250,000 hard day one, which is definitely the most I think we had seen on any deal here in DFW.
Yeah. Yeah, I mean, when we say hard money day one, it can mean a lot of different things, but all 3 of those groups were 6 figures.
Yeah.
So it was significant, and they were all of them were willing to take a pretty big risk, because for them too, it was a really fast close. It's mixed use. None of those groups were going to be able to build all the uses. So we're going to have to figure out, what to do with the balance of the site. But I can't say enough how thankful I am that we were able to execute on that, because that was one where there was just so many different things that could have gone wrong. At the end of the day, we sprinted for the entire time, and the developer ultimately had less than 45 days under contract, all in from signing the contract to closing, and they performed, which was incredible. So really impressed by them. And anyways, we're really incredible deal. I've never worked on a deal like that, but that, we were able to do that for the client, and I know they really appreciated that we were able to make both those sales, because that was kind of it was a bookkeeping thing for them. They wanted it sold by that point. And so being able to execute in both offices with different buyers on the same timeline was pretty exciting on that.
Well, I think a huge part of that too, Tom, is picking the right buyer, because you get a dozen offers. If you pick the wrong buyer and someone comes back and either can't get it done, which easily could have happened, or they're trying to retrade you at the end and you have to be closed. I mean, there's no chance to have a backup group come in and close it because of how tight the time frame was. So we had to really execute, perfectly to make this work. And the fact that both offices were able to pull it off, I think that's something we're really proud of this year, that we could do that.
Yeah. And then so that was one that I was thinking about. And then Trey, you had another one you were thinking about that we worked on this year.
Yeah, I think obviously there's a lot that come to mind, but we have another multifamily closing this week that is a site in Grand Prairie that's a second phase with Alliance that we marketed. We put them in phase 1 and then marketed phase 2 for the owner. We got 20 offers on that, and ultimately on that deal, we got to a place where the price jump between the 2 phases was about 30%. So that one's pretty incredible. Just to be able to deliver on that and see that much of a price jump. I mean, it was literally closing last September, 2024 at the first phase, and then 60 days later we were at 30% higher pricing. So that was pretty surreal, and excited to get that closed. The other one I think we were talking about that is super exciting is just the Canyon industrial deal. That's a deal that same client as the group that we marketed those sites for, but that deal is going to be 500,000 square feet of industrial 4 miles from downtown Dallas. It's a very, very infill site. It's very hard to replicate that type of a footprint in infill Dallas at this point, with just where everything's developed out.
Yeah, that's a great one. I mean, it's called the Canyon because it has extreme topography,
Yeah.
and so the buyer on that saw, I mean, incredible job of solving issues there, and even had to go buy a secondary access point to make the deal work. Executed everything on a tight timeline. Really impressive job. So yeah, from an industrial standpoint, that's exciting, and we have a kind of a deal of the year here at DFW where we'll vote on what was the number one deal that we did, and it's an internal thing where we all vote. And that's one of the 4 finalists. All 4 of the deals that were finalists were deals that we've been working on since like 2021 in one way or another. So like the Canyon was the deal that happened this year, but we've been working with that client since 2021, doing BOVs, meeting with them, like so many meetings to talk about how they could divide this different site, what different pieces are worth, different uses that they could be involved with, just playing the long game, like year after year, until we finally got to the point where it made sense to bring this offer and do this deal. And so just kind of back to the endurance and the grit and tenacity it takes on these deals. The other big one I was going to mention, not to leave single family out, is we did about 1,000 lots down in McClendon Chisholm, which is a really difficult area to get entitlements and to get utilities to. It's near Rockwall. And that was a deal that we worked on similar. We worked on it since I think it was 21 or 22. I mean, solid 4 years of, and it was a deal where they're like having to find water solutions that involve like trucking in water for the community.
Gosh.
I mean, really complicated, extremely complicated zoning case. That a deal that died more than 9 times. I mean, just really, really challenging deal, but they closed on it. And it was one of those deals where when it finally got to the point where they're going to be able to close, the single family market had like softened. So then it was like a nail biter to get it done, and they got it done. And so it's neat to get to be a part of, 1,000 lots going in a really difficult area, but also the story behind it and just the work that went into it. So we had, to Trey's point, the 50 or so deals we closed, like there were a lot of just neat stories behind a lot of them.
Yeah, and a great one to mention for Central Texas. So they had quite a few noteworthy deals, but there was an Ascentone asset in Georgetown, 220 acres we bought back in 23 as a joint venture with Endeavor. And we were able to sell that in November for a really good price. Very great return for our investors and for Endeavor. And that was one, too. We were a little bit worried because, the single family market's been soft in Austin. We're like, man, are they going to need to extend or, not be able to close this deal, have to drop the price a lot? And they were able to get it done. So that was a really good one to get done for the Austin office, but also for Ascent.
Yeah, that's a great one to mention. Yeah, I mean, it's so I know we talked a lot about the challenges of the year. Very thankful for, the deals that did close. We saw a lot of clients, in the midst of a choppy year, be willing to come to the table and make deals happen. And, I think as we're talking about it, a lot of them were just almost like willing deals to happen. Just a lot of work and effort. And we talk about that a lot, like picking the right buyer, how important that is. We also have a lot of deals that fell out of contract where, the buyer maybe just kind of gave up or didn't press on or just didn't have the capital relationships, didn't have something figured out going in. We had plenty of deals die because of zoning or cities killing deals. That's always unfortunate when that's why a deal falls out. But overall, I think really proud of the year that we had. And I think we're all optimistic about 2026. I think it'll continue to be probably a choppy year in a lot of ways, but we've really laid the groundwork. And I think there's more now of an understanding of maybe the type of market we're going to be in. To your point earlier, Tim, I know people are still optimistic, believing it's going to bounce back, but I think generally the market realizes like there's just going to be more of a consistent, like we're going to have to work our way through it. Well, guys, this was good. I can't believe that we're actually putting a bow on the end of the year here. It's pretty wild.
Flown by.
So everybody have a good Christmas, and we'll get back at it with episode soon here on 2026 predictions, which will be fun.
Yeah, it will be. Thanks, guys. That was good.
Thanks, guys. Appreciate it.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.